How are you today?
Good. How are you?
Yeah, I'm doing well, thank you. Enjoying getting a little bit fancy in home today. So
You look very snazzy. Love the ISO beard and love the shirt. Looking good.
yeah, thank you. I try. So I just want to have a bit of a chat to you today about some rates and some questions we're having from clients. So recently we've seen that fixed rates and variable rates have dropped quite dramatically, but fixed rates in particular, they seem quite different to how they were a few years ago.
Yeah, definitely. I've never been a huge fan of fixed rates, mainly because clients would lock in at say 6-7% maybe 10 years ago, and the variable rates would end up dropping down. So wherever clients would fix, the variable rates would come lower, and then it would cost them to break that fixed rate. But we're to a point in the cycle now where the variable rates are probably as low as they're going to go. Even the Reserve Bank has come out and said that they don't see themselves lowering rates any further. And because fixed rates are so much lower than variable rates right now, it's looking quite attractive. So I've actually got a presentation, funny enough, if you'd like to see.
Perfect. That would be great.
Good timing. So I guess the biggest question for clients looking to fix rates is, should they fix rates? Is it specific to their scenario? Does it benefit them? So one thing that we need to know up front is that fixed rates are not for everyone. Anyone needing flexibility over the next 2 or 3 years should steer clear of fixed rates. So if you're looking to sell a property or purchase a property, you may be best off holding off on a fixed rate and just remaining variable so that you've got that flexibility. So that's a conversation that we'd have with the client to try and map out what their next 3 to 5 years looks like and if it's suitable for them. And if it is suitable for them, then, these rates, David, are ridiculous. 2.09% for owner-occupied and 2.59% for investment.
It's so low.
So I think a lot of our clients are sitting at, say, 3% for owner-occupied, would you say?
Yeah, and higher for investment, yeah.
And higher for investment, definitely. So potentially huge savings for them. And I just wanted to take you through a lender comparison and show you what a difference that makes. The average loan that we see right now for a refinance is about $450,000, so we'll use that as the comparison. And let's assume that for an owner-occupied loan, they're on, say, 3.10% with their current bank. We know that Bank of Melbourne right now, just as an example, is offering about 2.19%, and HSBC is offering a similar 2.19% for their 3-year fixed rate. So you can see the savings down here. If we look at HSBC versus the existing lender, over 3 years, you're saving $11,500. It's massive.
Yeah, it's a huge difference.
All right, and then take into account also that some banks are offering refinance rebates. So Bank of Melbourne, for example, is offering $3,000 cash back after settlement, just as a thank you for moving over to them. That brings your savings closer to $15,000 over 3 years.
It's a massive difference.
It's huge. Yeah.
Definitely worth considering if it does suit the client needs.
Yeah, definitely. So massive savings, great potential for clients to, especially in times right now where we're looking to improve cash flow and kind of hunker down and make sure that we're looked after during the restrictions that we're in. It's a fantastic opportunity, right? You can see that just on cash flow alone, we're reducing your repayments by almost $400 a month.
Yeah.
One of the issues that clients have with fixed rates is on a fixed rate, the bank takes away all the benefits. So no offset, no redraw, and you're restricted in how much extra you can put into the mortgage. But one of the ways that we get around that is that we split the loan. We do part fixed and part variable. And on this example, you can see it's still $450,000. We've got our income going into our savings account, and then our savings account pays the loan. And instead of having just one loan that's fixed at $450,000, we would just split that loan and make this portion variable. And let's say that we do this variable at $150,000, which would make this $300,000. So it's still a total debt of $450,000, but it gives the client the flexibility that they would want in a variable loan, so offset and redraw and making extra repayments, but then also the peace of mind and the low rates that come with the fixed rate. So you kind of get the best of both worlds.
Yeah, you can kind of target that variable rate to pay that down whilst the other loan is fixed. So,
yeah, exactly.
It's a great strategy.
So we are doing client reviews on a regular basis and getting around to clients and trying to, every 6 to 12 months, review their situation, see if we can make improvements. But for those clients that we haven't spoken to in a while, what do you suggest?
Definitely give us a call or send us an email. So as you can see, the savings are huge, potentially huge, if you haven't reviewed your rate in the last 12 to 24 months. So yeah, it's worth having a look at.
I think that shirt has made you smarter,
I
and the
agree.
glasses too. Fantastic advice. I second everything that you just said. Clients should give us a call straight away if they haven't reviewed in a while.
Yeah, absolutely. Well, thank you very much.
Thanks, David.